Welcome to the Pivot Boss Masters Core Principles module. In this section, we're going to cover auction market theory, which is perhaps the most essential piece of knowledge that you must understand as a professional trader if you want to enjoy longevity in this career. And what I'm going to do throughout this presentation is basically give you all of the information you need to understand the auction process. And through the understanding of the auction process, you will understand how to approach any auction in any market from both a responsive participant and initiative participant, and how to handle inefficiencies and efficiencies with regards to price in any market. That is the essence of being a professional trader, is understanding the auction, how price moves and rotates, and understanding the participants and their actions. So let's go ahead and get started here with auction market theory. Auction market theory is used to study how market participants act in an auction, including studying market efficiency, inefficiency, and optimal bidding strategies. What this means is auction market theory is in essence its own theory for understanding the market and its auctions, for understanding price inefficiencies, price efficiencies, value, acceptance, rejection, and then how to bid correctly, how to bid with the bidders, and how to offer with the offerers. So in essence, the auction market theory is your pathway to understanding how to trade in any market. A professional trader must have depth knowledge of auction market theory, as it provides a pathway to knowing how to trade any market and any market condition. And this is extremely important, because if you have a detailed understanding of the auction process and how certain market participants are going to react at different stages of the auction throughout the day, you have an upper hand that most professional traders, or most traders in general, don't know. If you recall, only 5 or 10% of professional traders make money, and those are the ones who really understand the auction process. They have a depth knowledge of AMT, and that is essentially what is required. You have to know your opponent, you have to know the process, and those that know the opponents, the person taking the other side of your trade, and those that know the process of the auction will be better equipped to trade successfully in any market and any market condition. Understanding auction market theory and understanding your role in the auction helps you identify how to bid with the bidders and offer with the offerers. And what that means is there are different roles in every auction. There are those that are responsive, that are going to wait for price to come to them before they act. There are going to be others that are aggressive, initiative, that are trying to influence price action. As long as you understand your role and what you're trying to achieve, you can make money, because it's these roles that help you define when and where to buy, when and where to sell, or how to sell. And basically, this auction market theory will be the basis, the absolute foundation for the rest of our Pivot Boss Masters course. There are many components to an auction, and having a keen understanding of each component allows you to trade the auction from a highly informed point of view. Skilled professional traders use auction market theory as the blueprint for trading all auctions. Again, auction market theory provides a pathway. It provides the blueprint. If you are this type of trader, you should be looking to trade in this manner. If the market is doing a certain thing, then you should switch your role and become this type of trader, another type of trader that looks for these things in the market. It's very, very simple, and we will look at those roles here later on in the presentation. But understanding the market again, understanding the roles of the market, gives you all the information you need to know when to buy and sell. Over the next few slides here, I have some great quotes and some homework reading for you as well. The precepts of auction market theory provide ways to read and understand the market, and so the intelligent speculator is armed in the way that any other professional is armed by knowledge of his or her field. That's by Donald Jones, who wrote an article, Auction Market Theory, in February of 2009. Basically, that link right there gives you a great, heavy homework reading so that you can just learn more about auction market theory. And it's very dense reading. And if you continue to work your way through it and reread it every month or so after you gain more and more experience with looking at trading through the eyes of the auction market process, it's going to make more and more sense, and it's only going to help your trading. Understanding this information, really understanding this information, gives you a leg up that only professional traders have in this field. Now, this is perhaps my favorite book, Mind Over Markets. Jim Dalton wrote it in 1999. This is weekend reading for you. Here's a quote basically on futures market auctions. If the open is considered below value, price auctions higher in search of sellers. If the market is considered too high by the market's participants, then price auctions lower, searching for buyers. Once a buyer enters the market, price begins to auction upward until the last buyer has bought. Similarly, the market auctions downward until the last seller has sold, basically constantly searching for information. That is the auction market process right there. That's the auction process in a nutshell. The market moves from balance to imbalance, and buyers and sellers come in at different angles depending upon what type of participant they are, and price auctions higher in seek of sellers and lower seeking out buyers. That's basically the auction process in a nutshell. And I would recommend reading Mind Over Markets here. Jim Dalton is my favorite book. Again, another one of those dense type of readings that may take you a couple of 2 or 3 passes to really get some of the information. But again, if you understand this text, you will understand how to approach the market, because it is based upon the auction market process. And that's exactly what we're learning here. Futures Trader 71 is a fantastic trader who gives out a lot of information on Twitter. He's been a proponent of auction market theory, volume profiling, and other things. Definitely some weekend Twitter reading, and even during the day here. So definitely do your due diligence there and do a little extra homework and read about some of the teachings that Futures Trader 71 provides. But his quote on auction market theory goes as follows. Put simply, the market is in auction. Price is set through a process called price discovery. This is where the buyers and sellers will continue to move the market in one direction or another until the opposite force is motivated enough to step in and stop the advance. The market will auction as high as it needs to in order to find sellers, or as low as it needs to in order to motivate buyers to see it as relatively cheap. So again, that's the market and the auction process in a nutshell. If you can understand this process, and I know it seems very easy here just looking at it, but when the live bullets are flying and the price is rotating higher and lower very quickly right at the RTH open, sometimes this knowledge goes out the window with your typical trader. But it's those professional traders that have an understanding of the auction process and what buyers and sellers are trying to do. That's when you can take advantage and trade appropriately according to auction market theory. So now that we have an understanding of the auction market process in a nutshell, let's dive into it deeper. These are the 5 key tenets of the auction process as I see them. Number 1, the market is in auction and operates solely to facilitate trade between buyers and sellers. That's the only reason why a market is around, right? If you go back to the oldest markets from the Stone Age, it's all an open auction that's there to facilitate trade between one buyer and one seller, right? Or multiple buyers and multiple sellers. But every single market operates exactly the same. It doesn't matter if you're trading in the stock market, in the futures market, forex markets, or if you're trading, at the rodeo and you're buying livestock. It really doesn't matter. The market is an auction and it's there to facilitate trade between buyers and sellers. Key tenet number 2, price is used as a tool to advertise value. Value is the dominant variable in the markets. It changes constantly. So price is used as a tool, right? Just like if you go to the grocery store and you see something's on sale. Why would the grocer put something on sale? To motivate buyers. So price is used as a tool to advertise value. If price rotates lower, it's moving lower to do what? In seek of buyers, right? It's seeking out buyers. If price pushes higher, it's motivating sellers. So this is something to really keep in mind, is when price is rotating above and below, it's seeking out sellers on top, which is supply, and buyers on bottom, which is demand. And of course, when to buy and when to sell according to value all depends on how the buyer or seller views value at that moment in time. So basically, the market is a collection of opinions of value, and value is the dominant variable in the markets, and it is constantly changing. So it is up to you to understand where value is and where value is likely headed should an imbalance occur. Key tenet number 3, price auctions higher to motivate sellers, supply, and lower to motivate buyers, demand. That's it. So price will auction higher, and as it's auctioning higher, it's looking for a spot where sellers, supply comes in to meet the demand. And then price auctions lower in order to motivate buyers, right? That's the demand. So if price auctions low enough, somebody's going to buy it. If price is auctioning lower and lower and nobody's buying it, watch out, because we're headed to new value at much lower levels before someone comes in and sees price as quote-unquote relatively cheap. Key tenet number 4, price auctions higher until the last buyer has bought, and auctions lower until the last seller has sold. So price will continue auctioning higher, obviously, until the last buyer is bought. At that point, price will then rotate lower. And price will auction lower until the last seller has sold, and at that point will then rotate higher, likely back toward prior value. And lastly, key tenet number 5, when buyers and sellers find an agreeable price, they trade in large volume, thereby establishing value. This is usually within some balanced range, right? So when buyers and sellers find agreeable price, they create balance, and that's where you see a beautiful bell-shaped curve, and that's where most of the volume is triggered or traded. At that point, you get happy buyers and happy sellers, and everybody is able to meet in the middle and facilitate trade. That is the entire goal of the market, right? The market is an option whose sole purpose is to facilitate trade between buyers and sellers, and when buyers and sellers agree on price, that's where value is established, and then a high amount of volume will then occur at that area so that buyers and sellers can handle their business. So those are the 5 key tenets of the auction process. If you understand these 5 tenets here, it will help you with identifying some of the best entry points in the market, whether you're buying or selling. The purpose of the futures market is similar to any other market. It exists solely to facilitate trade, and it does so by auctioning from high to low and low to high in order to find an area where trade can be best facilitated. Again, Jim Dalton, Mind Over Markets from 1999. And again, this basically gives you the auction process in a nutshell. And if you want to look at what that word story looks like in a circular flowchart, this is it. So this is my interpretation of the auction process. And basically the auction process is a circular wheel. You go from rejection to acceptance and then back to rejection. Or you go from acceptance to rejection and back to acceptance. So if you start on the flow here, balance on the top right, balance is acceptance. It's agreeable value between buyers and sellers. High volume is exchanged at that level between buyers and sellers as agreeable price is seen. That is value and balance. Once excess supply or demand hits the market, that's when you get range expansion outside of balance. When you get range expansion, That's when you get imbalance. Imbalance is a trending phase as price trends seeking new value. Once price has sought and found new value, it then reestablishes balance and trades within that newly established value and agreeable price range. So that is the circular process of the market. It's ever going. This is how the market basically plays out every single day, from tick time frames all the way up to monthly bar charts. That is how the market behaves. It goes from balance to imbalance, then back to balance. That's what happens. So price is in the balance range, excess supply or demand comes in, you see a breakout from that balance, you see a breakout from the range, and then you see imbalance as price trends toward newly established value or looking to establish new value. That's price discovery, right? So balance is acceptance. Imbalance is price discovery as price seeks new value. Once price reaches a point in that trending phase, that imbalance phase, and finds a spot where value can be established, it then rebalances itself and creates balance, where buyers and sellers then come in and establish high flow again. So this is the auction process. Again, nail this to the wall right there next to your screen and continue to watch the market. And every time you look at the market, associate it with this flow chart. What's happening? Is it market imbalance right now? Is it an imbalance? Is there excess supply or demand that's likely to enter the market? And if price does break free from balance and sees imbalance, where is the next area where value may be created? That's what you should be looking at when you're looking at the market. All right, the auction process is basically comprised of participants and value, right? Those are the two major components, value or price, and then the participants who's trading it, right? This screen right here is your blueprint to trading the market. When folks ask for a holy grail, they're usually looking for some type of black box trading signal, some type of guru just to tell them buy or sell here. But in actuality, this is the Holy Grail blueprint for how you should approach the market, if there was one. The Holy Grail is basically utilizing auction market process or auction market theory in your trading, along with proper risk management and trade management. Those two right there. Obviously, you have the psychological component, which comprises probably the largest majority of all of that information. But those are the three main things, right? So in this case, the auction process and participants, this is the blueprint. There are 4 types of participants in 2 categories. The first category is initiative, and the second category is responsive. Initiative participants are looking to influence price. They're looking to push price to new value. They're seeking price discovery. That's an initiative participant. An initiative buyer is a buyer who buys above value, betting that price seeks higher value. And we'll look at this on the chart when we do our second portion of the auction market theory. Initiative seller is someone who sells below value, betting that price will seek lower value. On the other hand, responsive participants are those that wait for the market to come to them and then look to capitalize on undervalued or overvalued situations, and then they look to push price back to value. They're just returning price back to value. That's a responsive buyer or responsive seller. So a responsive buyer buys below value. They buy price when it's on sale, and then they push it back to value. A responsive seller sells above value, overvalued, and then they bet that price will return to value at lower prices. So those are the 4 types of participants. When you're trading and you're looking at price on the screen, and you're looking at your charts and you're trying to figure out what you want to do as a buyer or seller, you should be looking at these 4 case scenarios and suggest that you need to be one of these. And you need to take the person's other stance. Whoever's taking the opposite side of your trade, they are the opposite. And you need to understand their position and what's going to get them to exit their trade. Because this is what it's all about. Price in the market moves based on traders or participants being forced out of their positions. Stops, basically. And in this case, as a trader, you should be looking to become an initiative buyer or seller when given the appropriate times, or you should look to become a responsive buyer or seller given the appropriate time. And you will be any one of these throughout the course of a day, as long as you understand why you're doing it and the goal behind each participant. Doesn't always mean that you're going to be right, but when you employ these rules, it tells you when to get out. It tells you when to get in. It gives you a much better opportunity for pegging price right where it should be at. The auction process also has OTF participants, other time frame participants. These are big parties. Big parties. These are institutions. These are big fish. These are the ones with the most money that play on higher time frames, because higher time frames allows them to basically employ more capital at that level. So when you're looking at these, you have to understand that OTF participants are any participant that's using a time frame that's greater than yours. So when you're trading, you have to be cognizant of day time frame traders and OTF traders. A day time frame trader is someone that's just trading the intraday charts, right? There's someone that will get stopped out based on a minor rotation or look to push price to short-term value. But OTF traders are looking at the much bigger swings in the price charts. They're looking at monthly, weekly, daily charts, or anything greater than yours, and then they're basically deploying their capital at the most opportune times in the charts, and those times can trigger the most spectacular moves in the market, the strongest moves. So if there is responsive OTF participation, it's usually seen at an extreme after a pullback, and then you see something like a buying tail or a selling tail occur. Initiative participation usually triggers range extension. So in this case, an OTF participant would be breaking or triggering or forcing a move through the top or bottom of balance in order to trigger an imbalance phase, seeking new value at higher or lower levels. So you have to be cognizant of the fact that there are higher time frame buyers and sellers out there, and those are the ones that really initiate some of the biggest moves out there. And you, typically speaking, want to be on the side of the OTF. And the second component of the auction process is value. So we talked about participants, the 4 types of participants, and then of course the OTF participants. Now this is value, and value is it's what allows you to discern when prices are over or undervalued, right? If you can identify value in the chart, you will always know when price is over or undervalued, when price is at a discount or premium. So if you can discern value in the chart, you'll know when price is on sale, or you'll know when price is overvalued. And each of these cases can provide an approach for trading that scenario in the market, either from a responsive or initiative standpoint, depending upon your opinion of value, of course. So these are the key points to understand about value. Number 1, price is used as a tool to advertise value. We covered this earlier, and basically it's if price is auctioning lower, it's used to advertise value to motivate buyers. If price is auctioning higher, it's used as a tool to advertise value to motivate sellers. Value, again, is the dominant variable in the markets, changes constantly, And this is what can make trading very difficult, because not only is there value in lower time frames, but each time frame has its own value as well. So depending upon your style of trading, you have to be cognizant, again, of value in all time frames. You have to understand where value is in the lower time frame. Where is it on a week, over the last week? Where is it over the last month? Is value pushing higher, or is it pushing lower? And all of these things are things that you really need to ask yourself every single day. Where is value? Where is value? And where is price against value? Is price way above value? Is price way below value? Because oftentimes, if you can understand where price is in relation to value, you have all the information you need to know with regards to, should I buy or sell? Historical value maintains significance in the future, right? So that is something that's very important, because the market has a memory. It has a memory. So that's why historical resistance levels or support levels will remain significant many months, days, weeks, months, and even years in the future, because that is a psychological level where the market remembered that level, and when price comes back to that level, the market will continue to have a memory of what occurred there. The last time around, this support was bought. So when the market comes down there again, it's an area of rejection and should be bought again until proven otherwise. So historical value maintains significance in the future. Letter E is demand drives value, and change in value reveals demand. Again, demand drives value. So if price is pushing higher and higher, that means that the buyers are in control, demand is in control, and that drives value higher. Value will shift higher to follow price in that instance. Change in value reveals demand, though. If price is shifting higher, continues pushing higher, and value shifts higher behind it, and then all of a sudden value shifts lower after a string of upshifts, that is something to be taken very seriously, because at that point it's revealing a change in value and demand, right? So at that point, the up move may be over, or you may see a complete flush and reversal to the other side. Again, we'll look at all of these in charts as well as we move through with the second part of auction market theory. The market moves from rejection, unfair pricing, into acceptance, fair pricing, then back to rejection. Again, it's the rotating factor of the auction process. We're constantly rotating. We're switching between phases. We rotate up from fair value or fair pricing, which is an acceptance, that's balance, and then we rotate higher or lower to a point of rejection. And that's going to be an LVN, like a low volume node, where price rotates. There's unfair pricing at an extreme, so price rotates back to value. And it'll continue to do that back and forth, back and forth. So that is something to keep in mind, that price goes from balance to imbalance, then back to balance. It goes from rejection to acceptance, and then back to rejection. And now to tie it all together, auction market theory. These are the key points here. Auction market theory provides the pathway for trading any auction. Price auctions higher and lower in search of value for facilitation of trade between buyers and sellers. When buyers and sellers establish value, price trades within balance, and lots of volume go through at that price level. Imbalance occurs when excess supply or demand enters the market, and that usually leads to a trending phase seeking new price discovery at new value. After an imbalance phase, though, price then reestablishes value and then creates balance, where market participants are then allowed to facilitate trade within a very comfy confines of a bracketed range. Knowing the cycles of the auction process and its participants gives you the knowledge required to have longevity as a trader. And I cannot emphasize this enough. Knowing and understanding the auction market theory and the auction process is your path to understanding the market. And when you go through this process of watching your charts and you relay the price is auctioning higher in seek of buyers or sellers, or and you go through this word story in your head, you will then begin to develop a keen understanding of that auction process, and that's going to help you immensely in your trading, and you're going to have much more confidence in your abilities and much more confidence that you are putting your money to work at the appropriate levels. So the auction market theory is going to be our foundation for the Masters program moving forward. This is the theory we trade, and now everything else that we'll put on top of this, that we'll layer on top of auction market theory, including our tools and indicators and setups, it's all being layered on top of auction market theory as the foundation for how we approach trading. And that completes the auction market theory for the core principles module for Pivot Boss Masters.